But hello, everyone, and you're welcome. It is TechB's Transformation Series. It's brought to you by Eco Innovation Center. And you know what Eco Innovation Center does. It's about accelerating and commercializing innovation, particularly those ones that are anchored on technology. Interesting enough, we've been running this for almost 50 weeks. I think this must be episode 45, 46, thereabout. And the whole concept is to continue to support entrepreneurs, continue to support your own entrepreneurship journey, whether you are building your business, you are adapting on the basis of everything that has gone on the external environment, or you want to get to a place where you are building it into an enterprise. So for the entire journey of your entrepreneurship, we're here with you. For TechBiz, it's about bringing thought leaders and experts who have walked the various journeys in the paths of entrepreneurship to come and bring the learnings to you. And if this is your first time, you would find all of the episodes that we've run in the last almost 1 year. You will find them on www.ecoicenter.com/webinar. This one as well, the video and the presentation will be available there in the next 24 hours. So I think the message really is you just pay attention. You can capture any notes of the highlights, but don't feel pressured to capture everything that Blessing will be saying, because you will have access to the video. You will also have access to the presentation. The most important thing right now, let's optimize our being able to join live. Let's ask questions. Let his content stimulate our thinking that enables us to ask real relevant questions that he provides the kind of support and answers that we need. I'm Doja Ekeriche, and you know that. And today we are talking about a fantastic subject that everyone is keen on. It's valuation, which is a big precursor to investment, right? We're all asking ourselves, how much is my company worth? You know, what is the current business value? What is the future potential? What tools are available to me to be able to calculate this? How do I attract investors? You know, interestingly enough, I got some data from Patek Africa, and it was said that in 2019, which was 2 years ago, there was $2 billion invested in African startups. $2 billion US. Last year, there was a bit of a shrinking because of the COVID pandemic and the rest. That number came down to 1.4 billion. This year, the forecast is that it's going to go up, it's going to accelerate in the space of recovery and the rest of it, right? We're already seeing it. From the beginning of this year, you're seeing the numbers that are going out in terms of investment, particularly in fintech. So I'm sure you're asking yourself, how do I get a piece of this pie? So here, let me welcome Blessing Ayemure. Welcome, Blessing.
Thank you so much, Doja. It's a pleasure being here today.
It really is a pleasure to host you, and I believe very strongly that this topic is timely, it is relevant, and it's critical for all of us, whether we are already, you know, in running our businesses, or at this point it is still an idea. It is extremely critical that we're able to value and we're able to get our businesses investment ready. So a bit of an introduction of Blessing. He's the CEO of Umugini Pipeline Infrastructure Limited. That company is a member of Midwestern Oil and Gas Company Limited Group. He's a business executive consultant. He's fully experienced in strategic leadership, technology analytics, corporate financial accounting, and people and community partnership skills. His former positions have been audit manager, chief accountant, financial controller, general manager, CFO at various times in his 25 years career. Now he's a CEO, overlooking the entire business, but he is, of course, you know, a financial expert. He's an alumnus of Uniben. If you went to Uniben, say hey in the chat box. Well, I didn't go to Uniben. I went to University of Lagos, but anyway. He's also an alumnus of Edinburgh Business School in Scotland. Lagos Business School, Harvard Business School. He's a fellow in ICANN, and he's also a fellow of Chartered Institute of Taxation, Nigeria. So we are in excellent professional hands on this topic, and we are looking forward. Blessing, over to you, please.
Thank you so much. Once again, it's a pleasure being here. And I look forward to an interesting discussion today. I think valuation is something that a lot of people are concerned about. So there is this perception that valuation is complex, is difficult, and indeed it is complex and yet not too complex. Depends on how you are looking at it. But let me start by thanking the Eco-Innovation team for this privilege and this opportunity. I am trusting that we'll have a fruitful deliberation today. Okay, so can I go on with sharing my slides?
Let's do that.
Okay.
While he's sharing, please, everyone, please, let's pay attention, prepare your questions, put it in the chat box. It's never too early, never too late. Put your questions in the chat box. And then we will be unmuting once Blessing is through with the thought starters, and then we can have a conversation. So let's make this as interactive as possible. We don't see the screen yet. Yes.
Is it coming up?
It is up. Thank you.
Oh, wondering. Okay. Okay, like I started from the base. Okay.
We like to see the money.
Excellent. So welcome once again. So I have a lot written, but I'm going to try my best to run through this. We'll just take them by exception. I don't also expect that we'll be able to do an MBA course in less than 1 hour. So we are going to try as much as possible to focus on some of those things that are quite critical and key, and also to guide us on some of the things we need to do as far as business valuations are concerned. So we are looking at being investment ready, and of course, simplifying valuation as much as we can today. So some of the things we will cover are stated here in the agenda. So for time, I'm not going to go through reading through, but just glance through what we are covering today. So things you must actively do to convert your ideas to reality. Let's start from there. So Doja did speak about the investment that have come into Nigeria, into Africa. There is a lot coming in right now. Nigeria is a center of attraction, and Africa is, with about 1.3 billion people. I mean, who will not want to come into the Africa continent to do business? We have the population, we have the people, we have the human capital, we have the environment, the weather, we have a lot of things working for us. So a lot of people want to come in. So we see different VCs, and what they have done in the past few years, especially 2020. So we saw Nigeria with Patak, about 307, with Disrupt Africa, we saw 150 million, and it goes on. So this is just to draw attention to the fact that people are actually coming to Africa. While many people see the problem, some other people are seeing opportunity. The question is, if we are all focused on the problem, why are other people seeing opportunity? We can't run away from the fact that there is problem, all right? We must be sincere. Or however, in the midst of problem, there are also opportunities. And we are hoping that at the time we get everything together, we should be able to, leapfrog as far as development is concerned. And I think the tech environment will help us. So the question today is, why are people coming? Why are people coming to Africa? Maybe you want to type in there for me to see. just in the chat box, why do you think people are coming? I've said a few things. Why do you think VCs are coming? Why do you think private equity funds are coming to Nigeria? They are coming to Africa. What is pulling them to this space? Maybe you want to use the chat box. Let's make this a little bit more interactive as much as we can. But please just type it in there, we'll follow through. All right. Learn from those who have done it before. That's where I will start from today. Don't ever think you have all the answers. Just answer, or just because you have idea doesn't mean you have all the answers. Ideation is distinctively different than execution. So let us, open our minds up as we do this entrepreneurial thing, as we do this business, as we run our various organizations. There are things to learn. There are people that are ahead of us. There are people that have done what we are trying to do. We can learn. We can, ride on their back and be able to do the things that we plan to do. We don't need to reinvent everything. So let us be open up. I think that's one of the reasons why we are here today. We want to learn. We want to share ideas together. Now, let's look at the various stages when it comes to startup funding. So we have the pre-seed, we have the seed, we have the Series A, Series B, and Series C, and beyond. Now, this is critical. I'm going to be drawing attention to why some of these various levels of fundraising for startups and even for matured entities are very critical. Because the fact is, what you aim to achieve at your pre-seed level is different from what you get at your seed level and your Series A, Series B, Series C level. All right. So if you want to value your company, for example, you must first of all understand where you are, in the value chain, in this, journey. Where am I? Am I starting up? So do I have the strength of negotiation when I get to the table with those that want to invest in my company? You have to be able to understand that. I have been involved in many discussions with startups that come in and they are pricing their company at level C or even at the very matured level. They say, okay, this company is going to be $1 billion in 10 years. So I want you to invest today 10% for $1 billion because I know it's going to be 10 billion in 10 years. So the question is that the right way to value your company when you are still at the pre-seed level or if you are at the seed level? Can you and should you be valuing your company at the matured level? Okay, some of those things. So some things to look at here at these various levels. What are we expected to see? So at the pre-seed level, for example, what do we see? At that level, what you have is proof of concept and prototype. You are trying to hire people. You're trying to get people together to work. So at that time, you are looking for money to actually prove your concepts, get your prototype to the market. You're trying to hire experienced hands, people that can join you to build this company, to bring this idea to life. So your requirement at that time will be different from what you have at the Series A level. When you have, revenue growth, you are looking at development at this time, you are looking at operations, you're looking at branding, you're looking at marketing. Of course, it goes on to growth, and of course, you get to large-scale expansion. So understanding this is the foundation of our discussion today. We have to understand where we are. We have to understand why we need funds. We have to understand what we want to achieve at these various levels, and what kind of investors are we going to be attracting. Some investors, they only invest at pre-seed level. Some others are willing and happy to come in at Series A level. Some are specialists at Series B level. Some are C, and some at maturity. So it depends on the risk appetite. It also depends on the strategy of the organization, the firm that you are talking to at a particular time. This will guide what you do. So if we take it a little bit, so I took now from this institution, this is what happened in Austin, in Texas, and also using some Silicon Valley numbers. So it might not be Nigeria. So I'm just using this as an example. So at level 1, pre-seed level, you might, I mean, for typical Silicon Valley company, they might be looking for a $10,000 or a $1 million. At that point in time, you are valuing your company. But this, for this purpose of this discussion, is for a guide, all right? Not every company will value like this. So that's why you see the range from 10,000 to 1 million. Depends on what sector, depends on what industry, depends on what you are bringing to the market, that will determine. But let's take this as for a discussion today. So you are looking for 10,000 or 1 million at that level. So how do you value this 10,000? How do you value this 1 million? I'm sure that's a question in many people's mind. So you see that at Series A, we had jumping from 1 million marks to about 10 million, all right? Because at this time, you already have a proof of concepts. You have your prototype. You have hired some experienced hands. You are saying at this point, I want to develop this proof of concept. I want to run my operation. I want to go into branding and marketing. So you have a product that you are taking to the market. And so what you are looking for is different. And the people you are attracting as investors will also be different at that point. Okay, let's move on. So who invests and at what stage do people invest? So we'll look at these various phases again. And you say, who are those that will invest at these various levels? So at the first level, which is the seed level, you have the founders that will be investing. So have you saved money down? Do you have some assets you are selling to bring into the company? You have friends, families, and even some fools around that want to throw money around. So you have the 3 Fs. There are people that want to give you money to start. These are people you know. These are people that have money. These are people that are family and friends. When you leave that level, you go to the early stage level. Who are those people you are looking at? You are looking at the friends, family, you know, and other relatives as it were. You are looking at individuals as well as angels, you know, those that are angel investors that want to come in at that level because they believe that they will get, you know, good bargain at this particular level. At the Series A, Series B level, who are those that you are likely to attract? You are likely to attract angel investors, you know, you are likely to attract early stage funds and VCs. These are the kind of people you see. So it goes on, you know, to the VC level, it goes on to the investment manager, to the hedge fund at public level. So these are there. I also gave from this slide that I picked, you know, tentative amount of what you might be looking at. This time is $1,000 to $250, and of course from up to $50 million and above you can raise. But again, these are just for discussion purpose today. All right, let's move on and see. Now, the reason why it is critical to understand the stage at which you are playing is because at that early stage, you know, when you are starting your business, it's called the valley of death. Those that are coming to invest in you, they are taking huge risk. So I know that you have the idea. I know that you believe in your idea. You believe in your business. You believe in the fact that you can grow this business to become a multinational. But hey, at this level, this pre-seed level, this startup level, this seed A level, what are you trying to do? You are trying to prove what you have. And somebody believing you at this time is taking a higher risk because the chances are up to 90% chances that companies at this beginning level might not be able to make it up, you know, even to Series B and Series C level of survival. So it's a value of debt. So if you sit on the negotiating table with investors at this level and you are talking and you are using your valuation, what you have, you know, proposed to be your valuation at level C, level D level, to say, this is what my price is, you might be overpricing your entity at that time. So I want to emphasize this because it's critical. You have to know the level that you are in. You have to know your negotiating and bargaining power that will guide you in being able to decide what exactly the market will be able to pay. All right. So again, digging deep a little bit on this, what are the things that you need at these various levels? Seed, startup, early growth, and exit. I've spoken about this. I'm not going to spend time so much on this. But let's look at this. Early stage existence. What are the things that are involved here? So the company is young. Growth is achieved through creativity. So it's just an idea. I have an idea. I have a concept. There's something I want to do. But at this level also, you are open to the crisis of leadership. Who is your partner? How are you trying to structure the ownership of this partnership? So there are challenges at that point. Anybody investing at that point in time in your business is actually sharing in that risk of the business. So it goes on to level 2, to level 3, to level 4, and to level 5 at maturity. You see the red line here showing, the maturity, and this is also showing the survivor of the company, the ability to penetrate and the ability to continue in business. So it's critical we know this, because if we don't know it, there is that tendency that we will think that somebody wants to cheat us, or we have leveled our business. We must understand a few more things about our business. Who are others that have done this business? What was their valuation? How did they go through this process? And that's why I started with, let us ask questions. Let us learn from those that are ahead of us. Let us read about what has happened in the space we are trying to break into. Okay, so I won't spend so much time here, but I will just go to what you have shown, the normal valuation, and as well as your target runway, the typical investor. So at this level, the pre-seed and the seed level of your startup funds, what are the things you are looking at? So you want to raise some money. At this level, you are trying to say, I want to run for between 3 to 9 months. This will also guide how much you are going to raise, whether from family, whether from friends, whether from third parties that are not related to you directly. That fund that you want to raise, you must be careful enough to know that it can take you through this pre-seed stage to your seed stage, where you are matured enough as an entity to raise the next level of funds. If you don't do that, you might be raising too little amount, or you might want to raise the money that will cover from your pre-seed, seed, and up to maturity, or even to level 3 and 4, when you are supposed to focus on just the pre-seed level, move to your seed level, and move on there. I also try to explain here what we are actually doing at various levels. So you have created a minimum viable product that works in some ways. You have identified a clear market and a pathway to that market with your product. Now, at the seed level, you have demonstrated some kind of product market fit and traction. You have assembled a high quality team to build out the company. So these are various levels. And when the investors are coming, these are the questions they are going to ask you. So you have to be diligent in knowing where you are, what you need, and what you are transitioning to after this particular level. Okay. All right. I'm not going to speak to all of them. I have a few slides. These we can make reference to later on. I just wanted to share some of those slides. Now let's go on to the issue of, okay, this is your capacity as an enterprise to understand and meet specific needs and expectations of investors. So I've given a foundation to some of the things you have to understand as a business owner. I've spoken about knowing where you are, the stage that you are in your product life cycle, in your business life cycle, in your industrial life cycle. You have to understand where you are at that particular stage. That will guide you. But while you are doing all that, you have to, from day one, as a business owner, be ready for investors. You have to keep your record. You have to prepare, and be at the very best in terms of accountability, record keeping, and transparency. Some people cannot separate themselves from their entity. So when it is time for investors to come, you don't have a record to show. Your company account is your personal account. You have to be ready. You have to understand the needs that investors want to see whether you are accountable. They want to see the checks and balances that you have in your system. So it is essential to bridge, that divide and financial and fundraising capability that investors and fundraisers expect from entrepreneurs, thereby significantly increasing your chances of being funded. Okay. Okay. Now, these are some of the things, the top 4 investors' criteria. So what investors will be looking at when they want to invest in your company. They are looking at your products, they are looking at your team, they are looking at your market size, and they are looking at your valuation. What product do you have? What is your competition? What market size are you looking at? What team? Do you have an A team, a B team, or a C team? How experienced are your team members? Have they done things like this before? Are they greenhorns from the university? Are they people that you picked from, other competing entities that are able to? So these are critical. Please pay attention to these as you package your investment pitch and deck to investors. They are very, very critical. I'm not spending time on that because I'm focusing on the valuation today. Okay, so looking at why should we? We value our business because, it helps us to prepare for some things. It helps us to be a potential target for investors. It helps us to put concrete price tag on our business. It helps us to look into securing additional funds for those that already have, started their business and they are looking at expansion and growth. It can also give a clearer overview of your financial health as a business. And also, if you want to sell part of your shares, either giving it as employee share scheme, or you have given already some of your employees that you have given share scheme want to sell, you need to also understand the valuation of the business to be able to move on. So we have valuation here. I'm not going to spend so much time on this. We can read them up. What valuation is. It is the economic value of business. But I will actually say that the valuation of a business is what the investor and the owner of the business have to agree. The thing with business valuation is the fact that some people say it's a science, some say it's an art, but I think it's actually an art that you want to try to put a scientific basis around it. There are things you can pick, there are things you can estimate, there are things you can use to review it. But the truth is, valuation of business is valuing the future, and nobody can actually tell exactly what the future is. So we can say our business is either $1 million today or $100 million. They are all expectation. If all other things are equal, we will hit the 1 billion. If other things are not equal, we can go below it. So they are all right and they are all postulation. So most times when you look at the valuation of business, it is together in the numbers and see that it's likely going to push for. So while you are pushing for a higher number as a business owner, the investor might be pushing for a lower number and everybody can justify their numbers. So it is not a science that you say we can plug it today and say this must be this. Unless you have a captive market, you have a monopolistic market, and every other things you have, can number of years, and you have all the things to actually achieve those patents. Otherwise, it is going to be difficult to say this is exactly what you want. So what does an investor expect from you that is a business owner? They are thinking of risk. They are thinking of the impact, and they are looking at returns. How risky is your business? For example, Nigeria is discounted because of risk. Those that want to come to Nigeria, they discount investments in Nigeria because of the high risk level. And what are the risks we have in Nigeria? We have risk of insecurity. We have policy inconsistency. We have the fact that Politics can change and new leaders might not be committed to what the people. So there are so many look at it and say, oh, a company sitting in the United States sold for $1 million. I am doing the same kind of business at the same level. Let them come and invest at exactly 1 million. You have to look at the thing. What team do you have? What size of market? What is the risk? All right, the political risk. So we can look at the political risk, the environmental risk. We can look at the technological risk. We can look at the environmental risk, and of course, the legal risk that we face. So there are many ways you can value your business. But I want to push for something today, and that's the fact that we should not be too emotional when it comes to valuing. We have to just know that we, as owners of business, we are trying to project emotions, and the buyer is trying to also project a front based on his assumption. We have to be able to understand what those assumptions are and defend our assumptions to a reasonable extent. So understanding some of the things to look at your business risk, your cash flow, your interest rate, your cost of capital, your earnings, your revenue. These are very critical when it comes to business valuation. I've talked about your risk. What is your cash flow? Are you able to sustain your cash flow? You know, and what is cash flow? Cash flow, what goes in and out of your company? Is it assured that this cash flow will continue to run? What assurances do you have? What about interest rates? If you are going to borrow money to leverage whatsoever equity people are brought in, what rates are you going to be looking at? You know, your cost of capital as well. What are other people paying? What are other shareholders, you know, willing to take for the same, you know, kind of investment? So these are things to make reference to as we go on. So how do we value this? I will look at this. This is getting a little bit more technical. I'm not going to be very technical with this today because evaluation can be very boring. All right. So what I'm going to do, I will leave these ones for reference. You have the asset approach, the market approach, the income approach. But towards the end, I try to also use a very simplified term to explain some of the things that we capture the same three as we go on. So under the
just a second, Blessing. Maybe if you can use one of the approaches to help show us a practical example of how we can, you know, value our business using one of the approaches, then, you know, that also helps it, practicalizes it for us and enables us do that for our own individual businesses. How does that work?
Okay, I think we'll come to something that look like example.
Okay, good.
As we go on. However, I would say that valuation, if you go too technical into it, can be very confusing. So I'm trying to keep it as simple as we let. Book value, for example, what are we looking at? You are looking at your assets and your liabilities, and you are saying, okay, you have a total asset. What is the value of your motor vehicle, your land, your computers and everything? Let's assume all the money you brought in to invest in your company and what you have invested additional profit to is about 10 million naira. So if that is your total asset, and then you have a liability, what you are owing. So asset is what you owe, and what you own. Liability is what you owe people. So you have a liability of maybe 2 million. You bought some stock that you have not paid for, or you have rent that you have not paid that is due. That's about 2 million. Then you can come and say your net asset is 8 million. All right. So is it right to say, I haven't deducted my liability from my asset, my company is worth 8 million? So there is a challenge here, because there are some that you can actually value like that, some entities. There are some you cannot value like that. So I'll talk about them more as we go on in this. So you have adjusted book value. Okay, we are saying the book value is not good enough. So we have to do adjusted book value as we go on. So bring in some more variable. We have liquidation value, price to revenue. I'll just go through it. So I have a lot of things written here. We can go through it later if we want to go through this. I want to run through this so that I can come to, my time is short here. So I just supply these as references, okay? The reason why you have to use the market approach, and why you're earning, what is your EBITDA. For those that don't, you can ask specific questions. I'll answer them later on some of the terminologies. I know that it can be complex. So I'm trying to really simplify this very complex financial term. Business valuation can be very complex. Okay, but let me move on. This is discounted cash flow. Okay, so I've used three methods here: the intrinsic value method, relative value method, and the applied model. Now, what is the intrinsic value model really looking at? It's looking at your future cash flow, all right? As a business, you are asking the questions. How much do I currently make as revenue, for example? How much am I going to make in the next 5 years? So you can use that. So if I currently have a revenue of $1 million today, and I say, okay, I want to use a 5 years valuation model. So I can actually multiply my 1 million times 5 and say that is my future cash flow. And then we can base our discussion based on that I'm selling for you today, but you are going to be able to earn revenue for 5 years. So I can discount that back and say, okay, maybe you pay me for 3 years. Or I can say, oh, this business is very solid. It can earn for 10 years. All right. You can also look at the company fundamentals, like the things I've used before. You are looking at your assets, your liability, your brand, your goodwill. You are looking at those things and saying, I can put name to it. Because when you are buying a company, you are not just buying the chairs and the tables. You are buying the fact that there is a brand. You are buying the fact that there is a product. You are buying the fact that these people or this business already have an inroad into some market. That is what you are buying. So everything about the business you bring into that intrinsic value and say, this is what it's likely to be. The second part I want to say is the relative value method. Okay, my business, especially for startups, how much are other companies selling or others that have sold? What was their value? So I am into hair care product, for example. I started 5 years ago. I'm in the same line with another company, ABC, which is doing the same market size and everything. If that company is not quoted and does not have a market price that we can use, even though market price, as good as it might be, it is also very deficient because it depends on when you are buying. If news are filtered into the market and prices have gone up and you buy at a peak and there is a correction, you might have actually paid a premium that is not sustainable. Okay, but market price is a very good way of valuing if you are a quoted company. But I want to believe that most of us are not having quoted companies today. So we actually have some complicated models. Some people actually also believe that your model have to be complicated for you to have good valuation. No, you can actually simplify, your process of valuation. You can simplify it by asking the relevant question. Which other company is in the same line of business? How much are they valued? Oh, company ABC was sold last time. Okay, they are 20% bigger than us. They are 30% below us. How much? You can discount that. All right. This can make it, quite a simplistic way, but very simplistic. That is not how it is. I also expect that while we share these thoughts today, for you to actually do a business valuation, my encouragement, professional. All right. Don't sit down on your own and revalue your business when you want to go into either acquisition, merger, or getting a shareholder in. You might be cheating yourself because the person you are talking to might be very sophisticated and you are coming in with a very crude knowledge of valuation. So please talk to a professional in the field. Let them advise you. I want to believe that today's lesson is to let you know that, oh, I can think like this, I can think like that, but not to make you an expert business valuer. Because no, even financial experts find difficulty in business valuation. It's very complex. There are algorithms, there are models that can actually be very complicated when it comes to business valuation. Then the applied option model. Okay, this is contingent about a happening. For example, I use an oil and gas. If you check the balance sheet of an oil and gas company, for example, you are not going to see their most tangible asset written in their books. It is their reserves. Okay, but it's not written, it's not shown in their financial statements. So it is your ability to turn those reserves into, producible crude oil that will make the value come alive. So when you are valuing such a business, you are saying that I have a 2P reserve or reserve, and I'm able, all right, to bring this thing to light. Also have maybe patent for some kind of product, maybe biochemical product and all the like, and it's a thing that you are going to bring in the future. They might not be in your books. So you see the reason why we said that using your total asset might be very deficient, because it's not every entity that can put their value of asset in their books. And the typical one is the oil and gas. Their most valuable asset is not in their financial statements. It is in the fact that one report written by a professional somewhere that they can do XYZ value in the future. All right, let's move on quickly because of time. Okay, so we look at other quantitative valuation methodology. We can make reference to this. We have the discounted cash flow. Discounted cash flow is looking at the cash flow for the future and trying to add the discount factor, which might be the interest rate, or this can also be something that can be complicated. You know, when you are using the discounted cash flow, you are looking on the value of your stream of income in the future at today's value. All right, so we can make reference to all this. I'm not going to spend time on them. Let me go on quickly to steps to develop startup growth strategy. Now, you must add value to your business to be able to increase the value of what people would be willing to pay. Today, we are talking about ESG globally. Companies, venture forward capital, private equity, there are lots of funds out there, and they are looking at people that are committed to the environment, to social issues, and to governance issues. If you are able to demonstrate, you know, that you pay attention to environmental issues, you know, your carbon footprints, you are looking at, you know, how you deal with the issue of waste, your building, is it eco-friendly? You are looking at your social issue, diversity, for example, your employee, you are looking at your governance. If you can demonstrate that, you actually have a premium over people that don't even understand this. So sustainability is key. And the only way businesses can be sustainable is when they pay attention to some of these variables. So let's begin to look at our business and ask the questions. What are investors asking? I have had some discussions with some fund managers, and the moment we just talk about a particular industry, they will say, sorry, we don't invest in that industry. Our charter does not support that we invest in this industry, because they are all looking at the future. So we must look at how to position our entity. Our value proposition is very key. We must be able to analyze, define our target market, set up our key performance indicator, review our business model, and always check on our competitors. Okay, let's come to very basic, simple. Like I said, I don't want to complicate the discussion today. So, okay, Andy, an entrepreneur, wants to raise funds from a VC, is asking for 1 million naira, dollars, pounds, euro, whatsoever that is, and is offering about 20%. Okay, so what is Andy saying? Let us look at this. What is he saying? So if you value this, Andy is actually saying my company is valued at 5 million today. That is what he's saying. So you sit before an investor, you say, I'll offer you 1 million. I mean, I need 1 million for 20%, for 30%, for 40%. I think we see that in this Shark Tank. So I did something in the next slide to show the breakdown. So we must understand what we are saying here. So I did this on valuation, Shark Tank maths. I got this from a particular site. So I just modified it to reflect what we have here. So if you come to say, I need 1 million. So we are expanding our discussion now. I will give you 5% for 1 million. You are telling the investor that your company is worth 20 million. The question is your company worth 20 million? The investor has a right to push back. If you are doing a 10, You are saying is what? So as you increase the percentage that you offer to your investor, what you're actually doing is that you are reducing the value of your business. So the first thing to do is to understand the variables we have been talking about. Ask those critical questions. What is my product? What team do I have? What is my market size? You know, ask all those questions. How ready are you? And when you are able to put some figures, check what other competitors are doing, so that when you stand before an investor and you are rushing to give 40%, you understand what you are saying. Is your company actually worth 2.5 or 20 million? What do you mean when you say, I will give you 10%, I will give you 20%? So that's what we have done here to show to us that those percentages we mention for certain amount, they actually speak to some things. And we can complicate this a little by going to say, okay, is this pre-money, is it post-money? Those are a little bit complication. I don't want to go into it, but understand what this is. Another thing I want to say is this. Those that are investing at the early stage of your business, because they are taking higher risk, okay, they stand to benefit more when the business actually succeed. So you should be, you know, accommodative of the fact that in me, when I just have only an idea, is taking a higher risk, and I should be willing to share more. So some people that have succeeded in business. So talking points, because of time. Is your startup ready for seed funding? Is a question. Have you a well-published business plan? Any investor is going to have to look at that. Do you have, even when you are using a consultant, you still need to go back and have a well-polished business plan. Do you know how much you need and why? I have showed us at the beginning, at various stages, you have to be able to estimate and say, what do I need? Is it for 3 months? Is it for 6 months? Because if you don't estimate what you need well, also, you might run out of the cash within a shorter period, and then you are not able to achieve your first target. So it's good to understand how much do I really need? Is it a 3 months fund? Is it a 6 months fund? The third item there is to calculate the value of your startup. And like we have said, how do you calculate this? Some, they are very difficult to calculate. So what people do is to invest in some of those businesses without taking any particular equity. So somebody come and there's an agreement for future revenue, okay? So they sign and say, okay, I'm giving you 1 million, but we don't know the value of this business today. When you get to the point where you have your proof of concept, you have developed your product, and people are willing to invest, whatsoever people are willing to invest at either stage A or stage B will be the value that we will use to determine what I have given to you today. All right. And in doing that, also, you can moderate that amount by saying, okay, am I going to give you at a premium or at a discount? Most times it's at a discount because the person was there before every other person. So there are many ways we can look at this. But if it's an already established business, it's easier, except when you have your books. Number 4, be ready to share equity in your company. Be ready to share equity. Some people come and say, I want people to invest in my business as debt. I will pay you 10% per annum or 20% per annum. After 3 years, I'll finish paying you. I will just walk away. The question is, what is the appetite of or the desire of the person that want to invest in your business? Are they people that want to just do debt, or they want to do equity? Now, you also have to understand the implication of debt and equity in your business. You know, if you are somebody that does not like risk too much, equity is better for your business. When you borrow equity, it means that if the business succeeds, all of us are together, we are succeeding. If it fails, all of us, you know, we also suffer it. But if you take debt, it means that if the business fails, you are still going to have to look for money to pay, unless it is secured only on the assets of the business. All right. Take into account the personality of your investor. Very, very important. Some investors come and they are very problematic. They want to take over. We have had some issues in Nigeria of recent as well, and not only Nigeria, globally. Seek legal counsel, follow the requirements of SEC and other regulatory bodies. And of course, you also have to exhaust other options. Okay. Okay. Are we still on? Can you still see my slide, please?
Yes, we can. We definitely can. What? Yeah.
Okay.
So you just tell us at what point we can start asking questions so that we take those questions.
I'm almost done with it now. So when entering into agreement, get well-grounded legal, financial team, formalize all that you need to do. Just ensure that you follow the processes that you need to follow. Let me tidy this up. The things you must do: learn common valuation methods. I've tried to give you very, very, very basic, simple ones. If you want a complex one, talk to a consultant, all right? Will not be able to take you into complicated valuation methods. But the things that are critical is, what assets do you have? What did you bring in? What is your sweat equity? All right? The fact that you have an idea alone is an equity. Don't discount that. And also try your best to invest something in your business. People invest in people first before even the products. So when you are starting a business, it's not the best way to come empty-handed, nothing that you are tying into that business. It is always good to put something, no matter how small, in addition to your time and the fact that you are the one that conceived that idea. So it's good to know that and be able to understand what it is. That kind of business, that the motor vehicle, the land, the rent makes sense? Or is it the one that is an intellectual property like fintech or entrepreneurs, when we have ideas that we cannot really quantify? How do I quantify that? The best way is to look at comparative companies that have gone through this process as well, and then you are able to ask the relevant question. Review terminology and definition, explore valuation calculation, talk confidently with your investors. Your investors are not doing you favor, neither are you doing them favor. You are both seeking to achieve purposes, and while you are adding value, they are also adding value. So don't come in to a negotiation table as a beggar. All right. I know that in Nigeria or in Africa, it is difficult to attract people, to attract funds into our businesses. But please, you must understand your business, understand the environment, take ownership of it, and be confident. Marketing skill, that is very critical. Okay, now I've said some things here, but I will just leave it for reference later. But I don't know whether to show that now. Okay, some areas you can raise from. Maybe we'll come back to that later if we have specific questions on that. I think I'll stop here to continue later. So thank you.
Thank you. Wow, this is like a mini MBA. You try to condense everything into almost an hour, and we're really grateful. For me, I think there's just so many nuggets that I'm taking away from here. The very last thing you said, you are not going as a beggar, right? Neither of you is doing the other a favor. This is about opportunities, and so you go to the negotiation table with confidence. It is great. Thank you, Blessing. And you're already having some really positive feedback in the chat box. Guys, please, the presentation will be available from tomorrow on ecoicenter.com/webinar. So they keep posting the websites in the chat box. Don't worry. We'll just go there and then you can get all of the content, slides and video. Please put in your questions now in the chat box, or raise your hands and we can unmute you and you can ask your question verbally. But listen, I'm going to start, right? And I'm going to be talking about projected revenues. You talked about that quite a bit, right? Is there a scientific way to project that revenue, to work out what the forecast is, and to be able to confidently bring that forecast to the negotiation table?
Oh, did I lost Doja or I am?
I think it must have been my network. Did you hear me? Oh la la. Can you hear me, or is it my network?
Yeah, it's like I lost you for a second. I don't know whether it was my network as well. So you were asking question about valuation. Are we still together?
Okay. Listen, I cannot hear you though.
Oh,
I'm wondering. Okay, thank you, Olaide. Thank you, Zega. Which one of us can you hear? Can you hear Doja or can you hear Blessing, or you can hear both of us? Because I cannot hear Blessing. Okay, both. All right.
I can hear you very well.
Okay, Blessing, to save time,
maybe I should respond to.
You go ahead, yes.
Okay, let me respond to the question. Your question was, how do you project revenue, as it were, projected revenue. Okay, so it's a projection. I think that's the first starting point, is a projected revenue. However, that projected revenue is guided by some principles. Okay, so we create a boundary condition within which we are able to estimate. So number one is your historical record. If you have been in business for 1, 2, 3 years, or even 6 months, you can say, based on track record, this is what I have been doing. And I've been growing maybe at 5% every 3 months, every 6 months, every 1 year. And you can extrapolate that to the future. All right. You can also use other, events to want to moderate your numbers. For example, are there seasonal fluctuations? Is there something that's going to happen in the future that will create more demand for your products? What are other competitors doing in the market? What is my market share and what are other competitors doing? Is there anything, any product line that I'm going to introduce that will enhance, what I'm going to be able to sell in the future? These are the things you use. But the simplest way is to look at your history, check what you have done, and then project to the future using other possibilities. I don't know if that is helpful enough.
Absolutely perfect. Historical trend, new product developments that you may be coming up with over time, your market share. Thank you. That makes so much sense, and it's very helpful. I'm going to unmute Olaide now because to ask the question verbally. Your hands are raised, Olaide. Please go ahead.
Yeah, good evening. Thank you, Doja and Blessing, for putting this together. I'm sorry, due to network, I have my video. Yeah, briefly, we have a biotech startup, and we produce locally. I'm actually joining the call from Lauren. So now, let me say, as regard the foundation is a bit of a headache, but poultry subsector worth over 1 trillion naira, and the drug and vaccine that we are playing is worth 50 billion annually. Now, if we are to do valuation, I just take poultry subsector out of livestock, and we have product for livestock and crop. Now, what are the baseline specifically that we can use for the valuation? Thank you. Do you get that?
Okay. Very well, Laide. Thank you. That was a fantastic one. The first thing that came to mind is if Laide is looking at the sector of 1 trillion and with a 50 billion or so market, you should get a professional sitting by you and holding your hand through this process. Okay, that's the first one. However, it's good you also understand how these things are done. Now, as your business grows or as you deal with bigger businesses, the method or the process of valuation becomes more complicated. There are models that are developed and everything is thrown into that model. When you are doing valuation, you have to be extremely careful both you that is selling and you that is buying. If you get your valuation wrong, don't forget it's not an exact science, but you should be near some reality based on some information you have. Now, if you get your valuation wrong, that might be the beginning of the death of that business, all right? Whether as an investor or as a business owner. So it is very good to ask the question, like you have talked about the market size, you have talked about the potential. Every of those variables, you have to put them, and there are models that have to be developed to capture every of these. So you start with due diligence. You know, you do the due diligence of the sector. You ask, who are the key players? What market share am I trying to get? You know, so the issue of data comes in here. What are the available information? What are other people doing in the market? You have to be able to do that. And I must tell you, and to be sincere, that getting a consultant to do this for you is not really that expensive if you compare to the value that you will get. So please, I will advise that while you read up, while you learn about valuation, is a complex one. Valuation can be very complicated. Even for multinationals that have all the resources with them, it's still a nightmare for them. Get a professional to hold your hand. But for a simple way, ask yourself the question, what market share are we going to get? What have we been selling? How much are we going to make? So you can project your revenue for 5 years, look at what your expenses is, and say, okay, if my expenses is about 20%, what is my EBITDA? EBITDA is earning before interest, taxes, depreciation, and amortization, which means it is the profits that you have control over before interest and before taxes. You can compare with other pairs and say, okay, if I'm making 20% EBITDA, others are making 20, 30%, I can project with that. So I will leave it at that point. I hope that is helpful.
Due diligence on your sector and get support, get expert support where you need it, especially when there's a bigger stake, when you are really dealing in a really large market. I'm about to unmute Awomewe, but before that, the team is asking about valuing intangibles, right? So intangibles like intellectual property, right? Intangibles like an idea. How do you value, which of these tools connects the most on to value these intangibles?
All right. So intangible is something that no matter the method you use, you are basically estimating the commerciality of your idea will be what. So if you're already in the market, you can use historical record and the future projection of maybe your customer, the contract you have signed, the potentials. It's just like when COVID struck, you know, most of the pharmaceuticals started developing vaccines. All right, how did they value that vaccine? Is the fact that they were sure that about 7 billion people were going to use that vaccine. So you are asking yourself the question. So when they were spending money on research and development, all right, maybe they knew that COVID would come, maybe they did not know, but they were spending money on research and development with the fact that when opportunity comes like this, they can monetize it. So it's not a straightforward method of value for when it comes to the applied method, applied future method that I use, which is one of the ways you can value that. It has to be based on the happening, a future happening. What is the demand for this product going to be? An Uber, for example, a Google, for example. Can you hear me? Can you hear me, please?
Yes, now I hear you.
Okay, please, the moderator, please, if you can give maybe a co-host to the other of my device, Blessing. so that I can switch when I have challenge is blessing. Maybe I should raise my hand so that you see it there.
Found it already.
Okay, excellent. So when I have a challenge with one, I can switch on to.
Okay, perfect. Let's do that.
Okay.
Thank you.
Okay, excellent. So I don't know if that is helpful when it comes to the intangible. So I gave example of the oil and gas or a biochemical company before, that you don't have your assets sitting in your books, as it were. How do you value it? It's going to be based on what the future holds. As demands, grows in that sector, as the reality of people using your products becomes more and more real. When Uber started, people didn't take them serious. When Google started, people didn't take, all right, but they got to the market, and today they are in billions and trillions of market cap. So it is based on use. It's based on adaptation. Adaptation is adoption, right? In the market and the acceptance of that. Yeah.
Okay. Awomewe, do you still want to ask your question? So now I'm asking you to unmute so you can ask your question verbally, okay? But while we're doing that, Blessing, okay, go ahead, please.
Okay, thank you very much, Doja. And Blessing, I really appreciate your presentation. It's clear, and I think I've been finding the answer. I got it today. But I want to ask something. You have shed a little light about one of my questions, in which how do you value ideas? When a business in the idea stage, how do you value it? Because if you are talking about the precede, using looking at the 3 Fs, they will want to know what is the value before family, friends, and anything can put money into the table for you to continue business. Even yourself, you want to know that this thing I'm doing has this value. That's one thing, though you have at least added a kind of enlightenment to it. Secondly, I'm working on a kind of research and idea, and I discovered that in terms of total addressable market and sizable market, is it in the stage of Nigeria using Nigeria as a scope? Is it possible to use a global total addressable market to calculate the sizable market in order to get a value of an idea? Is it good? Maybe you use like education sector now, you use a global sizable market of education, you now try to reduce it to a particular percentage in order to get the value of a business idea in a particular country. Is it the best thing to do?
Okay, thank you so much, Awomewe. I hope I got that right. Don't mind me. All right. Let's start with the evaluation of intangible again. So there are so many school of thoughts on that. Some people will use the multiples, okay? So when you say you are looking for 1 million, it's more like, okay, you can use a multiple of 5 or a multiple of 10. You say that is the value of your business. So when you are starting, you just have an idea. The truth is, between me and you, what is the value of that your idea? It's just an idea. If you don't bring it to life, it dies with you. And don't forget that ideas are free to air. There might be 1,001 person. It is when you begin to bring life. That's why when you leave that pre-seed stage, you bring life into it. You saw in our example that pre-seed was between 10,000 and 1 million. But the moment you move to the seed stage, you are looking at about 10 million. All right, though those are hypothetical figures, they are for the purpose of discussion. But let's even take them as serious numbers. So what it's saying is that at that level, when you just an idea, you are looking for money to buy the tables and the chairs. You are looking for money to register the company, to get the patents. You are looking for money to do all that. You are willing to say, okay, this company, if you can give me 200,000, we can agree that the value is ×5 of that 200,000, which is 1 million at that point, okay? Now, some people, what they do is they give you the money. They say, okay, see, we don't understand what the value of this business is. Let us have an agreement. for future earnings. So there's what we call agreement for future earnings. So you sign that paper that whatsoever we will be raising when we now develop the proof of concept, and we now get people to bring in money, and they all value it at that time, and they say it's 10 million. The 1 million that I put down becomes like 10%, isn't it? But it might not be fair to be valuing you at that stage B with those that are just coming in. So you might also receive a discount to say, okay, I was there before everybody. So maybe when we value it at level 2, you give me a 30% discount or 40% discount. So it is an agreement, for future earnings. So I'm giving you. Now, in number 3 is the fact that some people can give you what we call mezzanine loan facility, which is they give you that money and say it is both equity and debt. All right. So we don't know what the value is going to be. Because I'm giving you this money today, you will pay me back my money with interest, and then you give me 10-20%. Most times that percentage is hypothetical. It depends of you that is a business owner or person that is bringing the money. I don't know if that is helpful for that first one. The second one, quickly, we'll be talking. Can I go on, please?
Please.
Okay.
Please.
The second one, you talked about the size of your market, I want to believe. You use global or the local. The truth is, it comes to statistics and probability. So when you are doing, research, for example, what do? You have a sample population. What is your sample size? I mean, rather, what is your population? The whole of the educational sector globally can be your population, all right? And then you now come and say, what is your sample? What is your own universe? So maybe Nigeria is your universe, all right? So you now say, okay, in Nigeria, we have 50 million people in the education sector. Oh, can you cover the whole of Nigeria? No, maybe it's only South or Lagos, another 5 million. So you are reducing it to where you have influence, you have control, you understand the market, and you are going to play. So you can use the statistical formula to actually determine what your universe is, your global universe, and then narrow it down to where you think you are going to be having influence immediately in the market. I don't know if that is helpful.
No, I love it, Blessing. You're absolutely correct. It is quite helpful. The total market, if you're saying your service is national, indeed, your total market is the total number of people who attend schools or total number of students. Then you then say, okay, what is serviceable, right? Serviceable could probably be everybody who has potential to use that service. Then you have to keep funneling it down, especially in a market like ours where we have really huge numbers. You funnel it down from a point of maybe affordability, how many people can afford this, those who are tech savvy, those who have access. You keep funneling it to where you then have that defined market share that you can realistically expect to win. There's so many hands up. By this time, normally we would have ended because the webinar goes on for exactly 1 hour. But I can tell that this subject is so, it has such big interest. Please allow us continue to take questions, and we will cap it at 6:30 if you don't mind, Blessing. Thank you very much for your flexibility. So Temitope, I'm about to unmute you. Please ask your question.
Good evening. Thank you, Blessing. Thank you, Doja. This is really, really needed because the space is tricky. In the on-demand business, I created like an app provide housekeepers for demand. One of the major trends I see with the on-demand business is how profitability is based on volume and a stretch of time. Let's take for example, for so many years, they were just not profitable. They were valued at enormous amounts. So my fear is, does that kind of valuation work in Nigeria? Also, considering the fact that there's a huge security risk in my own kind of business, I'm skeptical I might not get investors. So that's another major setback that I'm not getting me. And I keep asking myself, is Nigeria ready for on-demand startups? Because we've been having so many issues around people, them delivering on on contracts. So yeah, that's basically my question. Profitability take so long, but will it not affect the valuation? Security as a risk factor, won't it affect valuation? Basically, that's my question. Thank you so much.
Okay. Okay, thank you, Temitope. I struggle to hear you clearly, but I'm going to try, unless Doja, you got him.
Honestly, I cannot help there because I thought it was my own local network. That's why I couldn't hear properly. But the thing that I kind of heard there was it's an on-demand service, and there are the environmental challenges that we are facing locally in Nigeria. How is that impacting the interest of investors?
Yeah.
And is the country ready for that level of investment?
Yeah, and I think another part I heard is the fact that are people willing to invest in your business when you are not making profit for a long time, you know? And give example, I don't know whether it's Uber now or so. If I'm right, I will speak to that. Okay, so the issue with startups, techpreneurs and all is the fact that when you are starting those businesses, they are all ideas with the mind that they will succeed. Is what we really need for startups is actually what we call patient and ready to wait for some time, not in a hurry to be careful of who is investing in you as a startup and know the kind of business that you are in. If it's a business that is not going to make money overnight, you don't go and bring in an investor, you know, that want to make their returns in 12 months and go, when you know that 5 years, 7 years, you might need to for incubation. So patient capital is very key. There are investors that are very good with patient capital, especially when it comes to those that are investing in green bonds and some VCs. That's their specialty. They can wait for 10, 20 years. So go for those kind of bonds. In terms of the environment, I think there is a tool people always use, this PESTEL tool, to evaluate your environment if you want to invest. You have to check what is the political environment, what is the political situation, what is the environmental issue, you know, what is the security issue. You look at the technology, social, you know, you look at all of them together, the legal issue as well. So you have to do that evaluation. And this comes when you are doing your business plan. During that time, you are supposed to ask those questions when you are doing risk analysis of your business and your environment. So those questions will be asked. Can people, or are people willing to invest in Nigeria? Yes, but the risk profile is very high. So they take a premium for that.
Blessing, at this moment, you know, it's interesting that people are even still joining. They're still joining now. Your discussion is so pertinent, and thank you for giving us a mini MBA. The question is now relevant that takes us back to the slides that you haven't shared with us yet. Where can we get these investors? Okay, so Doja and I did discuss before this class started, or this session started, and I said, okay, let me quickly pick up a slide or two from a section that I had with somebody. So it was actually somebody that shared this. So I just picked it and included it here. All right, looking at recent effort by government and others to rejuvenate the small scale industry in Nigeria. So these are some of the things. First of all, I will say that I know that it's difficult for some people to believe that you can get support in Nigeria, all right? You can get funds in Nigeria. It's very tough because there is an issue of trust between the people and the government. We have had the basic necessities, we are not even getting it. How can government just give you money for business? So people are asking a lot of questions, but in reality, there are multiple institutions that are set up and structured. So we have some of them here. You can go through them. You can Google them. I will also say Google is your friend. When you go to Google and ask what funds are available in Nigeria, you are likely going to get them. There are so much. So you go through some of these. I'll go on. Okay.
what to leverage on. These are additional funds that are available: the Special Women's Fund, the MSME Trust Fund, the Business Development Fund for Women, the SME Council at the federal and state levels, the National Enterprise Development Fund, National Industrial Revolution Fund, Real Sector Support Fund, Creative and Entertainment Industry Fund, Shell Petroleum Development Fund. There's so much. It goes on. So these are some of the things that are available. Actually, I will credit this list to Dr. John Isemede, who shared it in the session we had last time. So he shared these details, and they are also available. You can get them. You can Google any of these funds more specifically, and you will see the requirements. You have a lot of them, really a lot of them. Government support institutions are there. Federal Ministry of Trade and Investment, Federal Ministry of Foreign Affairs, So we have these huge opportunities in Nigeria. And I want to encourage every entrepreneur, don't sit down in your corner thinking that there is no help. Try, especially when it comes to Bank of Industry. Bank of Industry is doing a lot. I mean, I know of somebody from Bank of Industry that kept calling. We have funds. Do you have people that need funds for business? This kind of business, this kind of business. And I'm sitting there asking, you mean these institutions are looking for who can borrow money? So that's why I started at the beginning with how are you structuring and positioning your organization? Because those things count when it comes to assessing funds.
Thank you, Blessing. Thank you. I think that this list, and the list is inexhaustive, right? I like the fact that you brought to us a list of what is possible also locally. There's even still another list of so many institutions that actually support African entrepreneurship. And like Blessing said, Google is your friend, right? Let's check. Although Oluwasegun is saying all these government funds take huge money to process, his experience with BOI is bad. Listen, I will tell you, Oluwasegun, if you saw Blessing's, one of his slides, the very last bullet point said network. So important. Network in your industry, network, with startups. Make sure that you're a part of those communities, because that's where you get to hear what's going on. If BOI is approaching Blessing and his organization asking for people to come and invest, and you are not part of that network, hey, you won't have access to that how we say, we like to call it connection, but call it anything, it is network. So you want to make sure that you are networking, and I'm sure, Blessing, you have a lot of things to say about that. We have 3 minutes to end. Olaide has been raising hand, but Olaide asked the question earlier, right? I think so. Am I correct, Blessing?
Olaide, okay. I'm not
okay,
sure.
Olaide, could you please make the question really, really short, because I know that you've been raising hand for some time. Asked you to unmute. Please go ahead.
Yeah, thank you very much. I think I asked a question earlier, but that question was not properly taken care of as regards the valuation. Of course, okay. I know that I have to talk to consultant on it, but the challenge I have is it possible for us to get this conversation further? Is it possible for us to get consultants that we have equity in the business? I'm open to collaboration. Let's get the team work. But if we are still fixed up, we are doing remarkable in the sector we are, but the gap is still there. So I wouldn't know if you mentioned about consultants. If you can do equity sharing, let's get to work so that we.
Okay, Olaide, I'm going to mute you back. I'm sure Blessing got that. So, which is very much about what is in it for the consultants. But go ahead, Blessing. And in that vein, also tell us your last words. Are you available as a consultant as well? I already saw that question someone was asking in the chat box. Please go.
Okay, thank you so much. Olaide, the sincere truth is when it comes to valuing your business, we can look at all kinds of methods. You can look at your market, your future projection. You can look at what other people are selling. There are so many things we can use. But when it comes to the reality of having to value in order to attract either bank funding, investors into your entity, there are some level of professionality that is required. And at that point, that's where we say you need somebody to handhold you through the process, okay? Now, in getting those consultants, consultants are everywhere, really. You know, you have them that can actually support you. I will advise you don't bring the consultant with the word of come and share. Treat consultant as consultant, treat equity investors so that you don't mess up, you know, your structure, as it were. I'm sure you can always ask questions from Eco Innovation. Did I drop my email? You can drop me email. I can refer you. I'm not really available as a consultant. Okay, so but I can make that reference if there is need to do that. The reason is that my hands are too tied now, and I'm trying to rescue myself from a few things at the moment. But indeed, there are a lot of people that are happy to do this job. And on a final note, I will say, once again, thank you to Eco Innovation Center. But I will say that there is huge opportunity. The challenges we have is our opportunity. But the truth is this: governance, governance, governance. We must embrace governance. We must embrace accountability as business owners. We must separate ourselves as individuals from the business we are running. Let us start from day one with a global outlook, even though we are operating local. Let us prepare our books as if we are going to have the best investors coming in the very next day. When you do that from day one, you are not going to run into trouble when the time comes or find difficulty with being an appealing entity for investors to target for investment. So I want to encourage us, let us embrace governance. Let us look beyond short-term profitability and focus on sustainability. Thank you.
Thank you, Blessing. Really powerful advice, powerful guidance. Listen, guys, we've talked about valuation, we've talked about getting your investment ready. So many nuggets, so many value bombs that Blessing has dropped this evening. And your last words were just resonating in my head. Create the right structure, governance, your books, make sure we're doing it right from the beginning. And we think, oh no, this thing is so expensive. Let me just be doing it, Sha. No, that is not how to run a sustainable enterprise. Start it right from the beginning. It's been an amazing hour and a half. Thank you so much, Blessing, for your patience. Thank you very much for the contents that you dropped. Thank you so much for doing this absolutely free of charge. And thank you to the audience as well. Your questions were quite stimulating, your attention span. And for sure, obviously, I could tell that people were asking other people to join. That's why even to the very last minute, people were still joining the webinar. It's Eco Innovation Center. It's tech-based. Every single Thursday, we come to you, bringing you these kinds of top leaders and clear guidance. Blessing, if you could just put in your email address in the chat box if you would like for the audience to connect with you via email or by LinkedIn. You would find Blessing on LinkedIn anyway as Blessing Ayemere, exactly his name as it is in the participants. You can reach out to him. Please, friends, please give the right feedback to Blessing in the chat box. Please give him the right feedback. I hear you say thank you so much, Blessing. You held nothing back. Thanks a lot. We really appreciate that. And Doja is the best anchor. Thank you. I like that feedback. I've been doing this for so long, so now I'm really used to it. Awesome, always on point. Thank you. Inspiring as well. Thank you very much. Have a lovely, lovely evening. Continue to stay safe. And next week is still about finance. Next week, we're talking very much about financing your business and how to get that, the sources of which to get financing beyond investors. There's a much broader space for you to get money beyond investors, and we're bringing another strong financial analyst, financial guru with deep acumen like Blessing that will come and share next week. Thank you so much. Have a lovely evening. Take care. Blessing. Bye. Bye, everyone.
Thank you and have a good evening.